What is going on, investors? My name is Andre, and I made a couple videos on Fubo already. And Mike, you wanted an update for Q3. So I went through the Q3 earnings call, through the Q3 results, and just took a whole nother look at the company. And I'm going to share my thoughts with you guys today. So Fubo is up almost 10% on today on some really good news we're going to go over. And first off, I just want to say, okay, first thing we do, institutional buyers are buying, insiders are not really buying. We're going to get on to that later. The biggest red flag I have with Fubo is its balance sheet. It is such an unhealthy company, and we can see that by the amount of goodwill and intangible assets they have. So I took out the calculator and I added up the goodwill and intangible assets. It came up to 763 million. If we take the total assets of 1.1 billion and we take out the non-existent assets, the intangible and the goodwill, we are only left with $339 million in assets. And if you look at their total liabilities, 880 million, and if you look at their current liabilities, 500 million. So they have more current liabilities due in the next 12 months than they do total liabilities. And it's just a horrible thing to see. We can see that in this quarter, their cash went down as well. It went from $260 million, what it was last year, Q3, to 150 million. And because of that, they have been diluting the shares like crazy. We can see just in this quarter alone, they diluted 6% of the shares. They went from 311 million shares outstanding to 331. So this is significantly hurting the shareholders. And now we can get into the kind of earnings report. But either way, their goal is to be profitable by 2025. But they have so much debt on their hands that even if they are profitable in 2025, it'll take years for them to recover. Fubo is in a very challenging industry, the streaming industry. It is growing because all the people watching cable and legacy TV are leaving and joining streaming devices like Fubo. But it is such a competitive market with streaming devices like Hulu, and people and companies that own the actual content will do much better than, for example, Fubo, who has to rent it all out from them and then get the subscribers to pay for that. Now, Fubo is a really cool company because they're kind of like have a startup mindset. They are innovating, and Fubo is one of the first people to launch 4K streaming and multi-view. So you can watch 3, 4 shows, however many shows you want on one screen, and you can watch it on as many devices as you can. The problem with that is it has no moat. All the other companies will simply copy them and still have better pricing and more content available. The other thing that I see Fubo doing is they're trying to go international. They launched in, we can see right here, US, Canada, Spain, and France. And of course, North America is their biggest customer right now. And I was really disappointed. If we look at the guidance for the rest of the world, we can see they expect a 14% year over decline in subscriber growth. And they're projecting 33 to 35 million in total revenue for full year 2024, which is nothing, guys. It is not growing. It is not growing at all. It should be growing much faster if we expect something good things. But if you look at the guidance for North America, it is representing a 9% year-over-year growth and 19% year-over-year growth for the subscribers, which is really healthy growth, and I like to see that. Now, if you take a look at their income statement for Q3, we can see right here that for Q3 2024, their subscription-based revenues did go up 21% or so, but their advertising revenues actually went down, which is quite surprising. And I believe that's why the stock jumped up today, because they did release some stuff on, we can see November 18th. Fubo debuts for new interactive CTV ad formats, including transactional and gamified ads. So they're using AI to help the advertising companies choose Fubo because they will get better conversion rates and making better ads, which is kind of gamifications using polls and all this stuff. But they're trying to grow that advertising revenue. And the other news that did release today, November 25th, is they're launching a bunch of new programs. A bunch of them are coming to Canada, and a lot of going to Latino programming. So this is, I believe, for the Mexican subscribers base that they're trying to grow over there. Now, if we just look at a quick insight of Fubo, it is not looking attractive at all. The return on equity, return on assets is really bad. They are not profitable. Their operating margin is 14%, which is really bad. And I think with a small company like this is it needs to do a lot of advertising and marketing. And on their Q3 earnings, they said they are spending, I believe, $140 million, which is the same amount they spent last year. The problem is this is money they don't have. They have cash runaway of 16 months, and they just don't have the resources to scale and to grow as a company. And the biggest thing is they're in so many lawsuits right now, the anti-competitive lawsuits, which takes a bunch of time away from management and a lot of money. We can see that. Year over year, they lost $100 million in cash. And this is not just for sales and marketing, but I believe a big chunk of it is to pay the lawyers and to be there on the court dates and pay all those expenses. And of course, the analyst projections, if you see next year projected earnings per share is supposed to grow 38%, revenue to grow at 10%. This is just not the attractive high growth that I was expecting. So this is one of the reasons I'm not investing. I believe there's a bunch more better opportunities to put your money into than Fubo. But if we look at this is what I've been playing around lately, kind of using this kind of chart. So this purple candle is the revenue, the orange is the cash flow, and we can see cash flow has been getting better. They're almost positive, and revenue has been growing like crazy. And at the same time, if you see the yellow, this yellow thing is the price of the stocks. The price is just going down while the business behind is getting better and better. But again, they're just in such an unhealthy spot right now. They're selling 2 times book value. The median book value they sell for is 1.5. And keep in mind, 2 times book value, half of that book value is in goodwill and intangible assets, which doesn't actually mean anything. So overall, if I would give this score out of 100, there's only a few metrics we can look at because they're not a profitable company. I would give it maybe like a 20, 30 out of 100. This is not something I will be investing in. I did do a swing trade before. I never actually bought the stock itself. And we can see in Q3, they were almost a cash flow positive. They were only had a negative 1.3 million in cash flow. But again, they're just in such competitive market and they have no moat and no means to survive and to thrive in the streaming industry. Because as we all know, the streaming industry will only have a couple winners and those guys will get all the revenue and have a monopoly. So for those reasons, I don't think Fubo is a good buy. I hope what I said helped you at all a little bit, but I'm more of a value investor and I don't see the value in Fubo. And I'm not saying it is the worst thing to buy. I think it is pretty cheap, but the share dilution and the balance sheet really are like a big turnoff for me. If they had a better balance sheet, I would be looking at this company a lot differently, but that's just not the case. So if you're looking at some better things to buy, some better stocks, you have check out some of these video guys. Thank you so much for watching, and I hope I'll see you in the next one.